Making a gift to children. What taxes should you be aware of? Check out this video as Louise and I will give you those ideas and what taxes you should bear in mind. So I'm away to be gifted. I'm just trying to work that out. So I'm about to be gifted, maybe.
Yes.
Commercial residential property from my father who's retired, which could be the most tax efficient way to transfer to myself, all in my own name, no mortgage-based rate taxpayer. Interesting. And I think what we need to do when we're talking about assets being given from father to son, but it could be mother to daughter. Why would you do that? And would you pass me the Coke? Would you pass me the sauce?
There you go.
Thank you very much. It's
No branding here.
no branding. You can't see the Diet Coke. Oh, sorry. Could be any. Could be Tesco. Oh dear. Anyway, why would it be advantageous to gift an asset from a parent to a child?
Well, I'm going to guess that you're heading down the tracks of the train called inheritance tax, perhaps. Inheritance tax is one of my favourite topics because there's so many different ways to, in the loveliest of ways, get out of paying any. What you sometimes find is when someone does pass away, any assets they leave behind could be subject to inheritance tax at 40%, which is an awful lot of money. So families are becoming very savvy to this, taking great tax advice and identifying ways to pass those assets during life. Because if you happen to give a gift and you survive 7 years after that gift, how much inheritance tax is then payable at your death?
40%?
No.
50%?
No.
20%?
No.
Go on then, Louise. What is it?
0.
Wow.
Big fat 0%. Happy days. The issue with transferring assets during your life, though, is that some of them trigger capital gains tax on the person giving away the gift. And that's where you have to be really careful because you might be ending up trying to save lots of tax in the future, but triggering quite a lot of tax right now as well.
And what we need to think about is how might you avoid said capital gains tax, because we could use the trust.
Great question.
So strap in because there might be a bit more detail. And by the way, I have noticed that the comments appearing on this new system we've got is actually cutting off our chest and chin, so we're almost having to elevate ourselves up a bit like a kangaroo answering questions.
I'll get my booster seat.
So I shall apologise for that. Yeah, I might need to just do something with this camera, just to move it back maybe. That's
now you're cutting me off.
That is shocking.
Honestly.
Well, we've always said we're going to phase people out of the show. Now, so let me I'll stop doing that. Right, okay, so why is it advantageous? You could use a trust, and the reason you could use a trust is TCGA. I always get this mixed up. 260, 162.
Section 260.
260, which basically means that there are ways of gifting a property into a trust, and then eventually out of the trust back to you as an individual child, and that would mitigate capital gains tax liabilities. However, it does reduce your inheritance tax lifetime allowance. So if you've got an asset that's single parent at £400,000 and you want to gift that using this trust mechanism, £325,000 would be exempt, but then you pay 20% tax on the excess of 325 up to the £400,000 of the property gifted. Am I right?
You are, so long as you're looking at things in retrospect and it's within the last 7 years post-death, because a lot of these calculations, particularly on the inheritance side, they're all basically conducted at the point of death, and then you look back over the last 7 years. So if that gift was gifted into a trust more than 7 years ago, there's a strong chance you might not end up with any inheritance tax issues at all.